Now, the CFG Advisory is maintaining a GDP growth forecast of above 5% for Nigeria this year. Now, the outlook is supported by the mining, oil and gas and financial services sectors, which are expected to drive economic expansion. However, inflation is projected to rise to 20% level as the pass-through effect of fuel prices begin to manifest, and exchange rates are anticipated to fluctuate within the 1,350 to 1,500 to the dollar band. According to Tilewa Adebajo, the Chief Executive of the CFG Advisory, he joins me now to highlight the opportunities and challenges ahead for Nigeria. Thank you so much for joining us on the show today, Mr. Adebajo. Your report notes Nigeria is stabilized but not transformed. What exactly is missing from the whole reform agenda that is preventing us from reaching, should I say, the real economic transformation you talk about?
Thank you very much, David. The challenge we have is that the reforms are under threat. Given the fact that we have the global headwinds with the increase in oil prices and the structural deficits and the structural deficits we have in this country, which is as a result of fiscal weakness. The fiscal management in the country is extremely weak at the moment, and that is threatening the reform. But apart from that, you see, it's not just the economy has been taken back from the brink. We've seen stabilization, the stabilization on the foreign exchange markets. We've seen stabilization in the macro stability. We're no longer dealing with stagflation, and we're projecting an in excess of 5% growth for this year. But that growth is not enough for the economy the size of Nigeria. Nigeria has to grow between 8 to 10% on a sustainable basis for us to have 140 million Nigerians out of poverty and begin to take a look at restoring purchasing power as a result of inflation, which has been at high as 30%. Now, as you know, we had very good success with disinflation over the last 15 months. But unfortunately, the aftershocks of the increase in oil prices as a result of the Gulf War, we're beginning to see the pass-through effects in our economic data, especially with inflation numbers. Fuel prices have increased by as high as 50%, and aviation fuel has gone up by over 100%. So the pass-through effects of these cost-push inflation factors are going to negatively impact the economy. When we're looking at inflation at maybe single-digit officially this year, but right now we're looking at inflation going to about 20% by year-end.
Well, talking about these macro indicators now, I would like to have your take around the chances of us having these sort of gains, which you've mentioned, being reversed. How close is Nigeria towards, should I say, losing the credibility we have with investors at this moment? I know that's a tricky question to ask, but where are we right now?
The big challenge now is the fiscal side of things. We have a 35 trillion naira deficit for this budget. And the government does not have the capacity to fund that deficit.
Would you still describe it as a debt trap?
Not yet. It's not really a debt trap, because what is happening is the fact that you're pushing out budgets that your revenues cannot sustain and cover. So the budget this year, they added 10 trillion to the budget, and without the corresponding revenue. So we're seeing a 35 trillion deficit, which is pretty significant. The whole of the pension funds in Nigeria is 30 trillion naira. So even if you took up the whole of the pension fund in Nigeria today, you're not going to be able to finance the budget deficit for just this year. And if you take a look at the pressure on the capital markets, they're beginning to crowd out. So far, between January and April this year, the DMO has raised 8 trillion. That 8 trillion figure surpasses 2023 and 2024 numbers. Total year numbers. And the 8 trillion naira raised so far in the last 4 months is at 80% of what was raised last year. So at this rate, you're looking at raising about 24 trillion from the domestic markets, and that is virtually impossible. So these fiscal challenges, I think, are going to be a problem. On the positive side, I think we've seen the ratings that have gone up by 1 notch, but it's still 1 notch below the best credit rating Nigeria has ever had. But we should also understand that this credit rating, we're still 5 notches below investment grade. So we're not there yet, but at least we're moving up 1 notch. And if you take a look at the report itself, it's very clear. if Nigeria does not manage its fiscal side of things properly and does not manage its FX rate stability properly, the rating agency says they're going to downgrade Nigeria.
Yeah.
And they said that if we manage those two things properly, they will upgrade us. So I think that therein lies the signal.
And talking about how we should also look at the government's response now, when you look at the story, debt explosion and our borrowing strategy in the last 3 years now, you've raised concerns as to domestic debts almost at 100 trillion naira in the last 3 years. Whether or not the surge was avoidable is a different case scenario. But your concern around us using dollar loans collateralized with our domestic bonds for recurring spending, one of the languages you've used is a little bit of recklessness within that regard.
Yes.
How do you think there might be a change in posture from the government at this point? Because we can't be using this sort of expensive foreign loans for consumption.
Well, you show me the capital projects these loans are going for. Most of the description of these loans, including the pending World Bank loan, the descriptions are very vague. Okay, the only two projects we know are the Coastal Road and the other Sokoto to Badagry Highway. But you do not use a commercial bank loan to fund those sort of projects. You use a World Bank 40-year, 2% interest rate loan to fund those sort of projects. So and even if you're going to refinance much later, you could see that those projects cannot pay back those loans. So those loans are going to have to be paid back from our revenue generation, which you know is already impeded. At $100 oil prices, Nigeria should be benefiting from a windfall. But maybe our benefit is only 10% because we've sold a lot of our crude oil forward. So we don't have the barrels to get this windfall. So we're still having significant revenue challenges.
So would you say we hedged away our windfall?
Oh, yes. That's what happened. Because right now we should be doing very well. And unlike other countries that have a sovereign wealth fund, as I always say, during the 2018-2019 global financial crisis, Nigeria had close to $25 billion in excess crude accounts. This money was not reinvested into our sovereign wealth fund, and today the stabilization fund in our sovereign wealth fund is less than $100 million, and our excess crude accounts is maybe less than $100,000 or non-existent. So we do not have the we don't have the buffers to be able to help us when there's cyclical challenges with global headwinds. So these are the factors that I believe is threatening the reform and the gains of the reforms that we have made so far. But on a positive note, the FDIs are still quite strong, close to about $30 billion, and that can explain the reason why the real rates, everybody expects that real rates to be positive in any society or any economy. So you're seeing the fact that inflation is about 15.8%, and the MPR rate's about 26.50. So there's about an 11% premium on the real rate return, you know, which is pretty healthy. But again, that is at an expense of growth. And you can see the strategy of the central bank is that they've kept that premium high and they've not cut rates to be able to reflect inflation. And really, that is the buffer that is saving us during this.
So now, would you say that the CBN is now being forced to compensate for the weak fiscal discipline we've had so far?
Exactly. Okay. That's what will happen. And in that way, by increasing interest rates or keeping interest rates high, you're going to compromise growth.
And then when we talk about how much of squeeze the average Nigerian should expect now, this 20% inflation forecast, I'm pretty concerned about it. How much of an income squeeze should we expect going forward, real income squeeze for the average Nigerian now, when we look at the ramifications?
Well, things were getting a bit better, as you can see, but you can see that the key number is the amount of Nigerians in poverty.
Yes.
That is now at about 140 million. We were expecting that maybe when inflation gets to single digit, the amount of Nigerians in poverty will reduce. But as inflation begins to inch up again, then you're going to affect purchasing power, you're going to affect consumer demand, and you're also going to affect aggregate demand. And that will definitely slow down growth and slow down economic development. And the government policies in terms of coordination for industry, productivity, investments, and trade are not in coordination. So there's need for us to coordinate our industrial policy with our trade policy and our investment policy so that you can begin to increase productivity and create employment. That is the key challenge in Nigeria right now.
And then, Mr. Adebajo, now when we're also looking at the risks ahead of the election now, chances of policy reversals, and I know you also had some, should I say, some concerns around the moves with the finance minister, policy continuity, all of that. Do you still have concerns within that regard?
Yes, there are concerns because, you know, those sort of changes reflect a change in policy direction. And right now, we have not seen an articulation of the policy direction.
Clearly states that.
It's clearly stated. The only policy we're all focused on now is the monetary policy, which has been consistent over the last 3 years. And I think that the 11% gap between the rate of inflation and the MPR, I think, reflects this risk premium that we're talking about, because ordinarily the gap between the rate of inflation and the interest rates, you know, at 11% is rather high. So it shows you that there is some sort of risk premium that has been factored into maintaining that to be able to create foreign exchange stability. So what you're seeing with that rate is being able to maintain our FX stability. The FX market did very well last year.
Yeah.
We had over 100 billion. In fact, according to central bank data, we had about $112 billion in inflows. And by the time you net that off in terms of the outflows, you're probably ending up with close to about $70 billion. So in terms of FX availability and FX pricing, I think we've seen that stability. So that premium you see between the inflation rates and the MPR rates, I think is the stability that we need to maintain for the foreign exchange.
And then let's bring into focus now our capital market. For the equities market, we're seeing year-to-date performance over 60%. Looking at the all-share index year-to-date returns now, when we look at that, whether or not we're getting to the peak of our bubble, and then when we look at the post-recapitalization chapter for our banks now, what must happen for the banks to further fund productivity rather than government debts? How do you also see this MPC meeting also providing further guidance within that regard?
Fantastic question you've asked, David. That is the compromise. Banks have raised close to 4.5 trillion in new equity. If you take a look at the books of the banks and take a look at the markets in general, there are concerns about price to earnings ratios, and there's concerns about there's a dilemma between their earnings and even their price to book ratios. Most of them are just recovering to above 1. And that is a real source of concern in terms of the valuation of the banks themselves. Having said that, I think you understand that 45% of the Naira deposits are held in CRR. So there's a limitation to what the banking deposits are. So you have a huge pool of funds that are not going into productive sectors of the economy, and most of these funds are going into government debt. So the question is the government crowding out the private sector when it comes to financing the debt markets? And if the government is crowding out the private sector, how do you stimulate growth in those sort of sectors? Because the banks are not lending, and the banks have they've cleared up the issues of their bad loans. And if they continue to lend at these high interest rates, the only result of that will be more bad debts on their books. But overall, if you take a look at the markets themselves, they reach record levels. The Nigerian Stock Exchange capitalization has crossed the US $100 billion mark for the very first time, which is quite impressive for the Nigerian market. And I think returns, have stabled, and the markets are defined. But the markets maybe still only 100 companies listed. So the market still needs depth, not only in terms of the amount of companies, but in terms of liquidity, because the average traded volumes are still very low. And your ability to buy shares and trade is still also limited. And the fact of this market is that we can't short sell on this market, which is very important. Because if you can short sell, then you can begin to look at more transparency and more dynamic pricing. And that is why the foreign investors are not investing more in our equity markets, and they're doing more of bonds and money market instruments.
Mr. Adebajo, it's always a pleasure speaking with you. Thank you so much for your time. That was Tilewa Adebajo, the Chief Executive of the CFG Advisory.